Right. Today is Sunday, August 20, and this is a recap of the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight, and we're coming to you live from Hurricane Hillary, of all names. When I think about Hillary, I'd like to think about Hillary Duff, not this one. But anyways, it's a lot of rain, a lot of wind, a lot of water, mudslides, you know the deal. So stay safe if you happen to be in California, all the way to Nevada, by the way. The deserts will be hit with a lot of rain, so stay safe. That's all I gotta say. But folks, the last video from this channel, the title was Looking for a Rebound. And I explained in details why we're looking for a rebound from a technical standpoint, from a mechanical standpoint. And here are two different comments by viewers who watched the same video. One says, no bounce back today. And the other comment reads, this video was spot on for trading today. Thanks, Mav. Topped a very profitable week. And listen, we've been doing pretty good, folks. Not just this week, for a few weeks now. But why do we have different views to the same story? The answer is both commentators are right. We got a bounce. I mean, you can look at the chart, it was a bounce from the lows. But was it the bounce? The answer is no. Did we see the climax? The answer is no. Now, what does that mean? It means that we're not done with this move down yet. Not even close. All what we're getting right now is a rebound. We're not going to underestimate or poo-poo the rebound right now. I actually said on Friday that we could see it going on all the way till Monday, maybe a little beyond. We closed all of our short-term put options Thursday before the close. And we said, look, we have to be ready for a rebound. We're going to get this rebound, but it was not the rebound, and therefore it's going to be short-lived, and down we go again. But folks, we'll take it one step at a time. We're going to talk about this and a lot more in the morning brief. But when you read the title of the video, it reads, no, I'm not wrong, the market is. And I know what you're going to say, Maverick, you have such a giant ego, you always want to be right, and you're not. Why don't you take it easy? And I would say, why don't you take it easy? Because I'm not talking about myself, I'm talking about the bond market. The bond market is saying, you see, you stupid motherfuckers, I was not wrong. The market and the rest of you were wrong. I've been telling you from the get-go, this is not going to end up pretty good. I mean, you look at the divergence that we have between the inverse of the 10-year and the NASDAQ, for example. The correlation stopped at around June. So why did that happen? Why did we see the stock market rallying higher, ignoring the bond market? Well, for one thing, we have perhaps the most corrupt Federal Reserve in history, led by a weak and spineless man called Jerome Powell. And he's been sending false signals to the stock market, false optimism all over the place, number one. Number two, we also got NVDA's earnings and the massive upgrade in revenue guidance. And that led to number three, retail mom-and-pop investors capitulated. They started to stampede and FOMO the stock market. But the bond market had been telling us all along, you're wrong. AI or no AI, NVIDIA or no NVIDIA, Jerome Powell or no Jerome Powell. You guys are wrong. I'm not wrong. You're wrong. And you're about to find out the hard way. Now let's do a timeline here for the stock market and see what's going on. This is the SPX, the daily chart. We go back to October 22, which is now known as the October bottom, which is not going to be the bottom, by the way. But anyhow, why did we bottom in the month of October 22? It was exactly the time when the Federal Reserve, led by Jerome Powell, signaled that they're done with the 75 basis points and they're going to reduce it to 50 basis points, and they see the path of reducing interest rate hikes. That was the moment when the market said, okay, it seems that demand is done and we should buy right now. And this is really important, folks, so you got to pay attention now. What does this behavior say about the psychology of the market and the psychology of the economy, most importantly? The answer is the market doesn't really give a about interest rate hikes or anything. All what the market cares about is, yeah, Mr. Powell, do whatever you want to do, raise rates, however high you want to go. It doesn't matter. We're going to be waiting at the gates, and the moment you capitulate and you pivot or you declare victory, we're going to go all in, buying the stock market and splurging in the economy, which, by the way, tells us that whatever the Fed has done is not even enough, not remotely enough to tame the sentiment by the stock market and the economy. But most importantly, where does that come from? Why didn't the market believe the Federal Reserve and Jerome Powell? Why did they just wait in the sidelines the moment Powell appears to be pivoting by reducing the pace of interest rate hikes? The market blasted higher. And the consumer said the same thing. The moment the Fed appears to be capitulating and done with the job, we're going to start splurging and buying stuff. That comes from the weakness, the lack of leadership by Jerome Powell, which in my opinion, he's the worst Fed chairman in history. Not even close. And this comes from the 2018 episode. When Jerome Powell was raising rates, the market went down by 30%, and the president at the time, Donald Trump, was barking. And Jerome Powell cowardly backed off, got scared, and said, okay, no more interest rate hikes. And he established the moral hazard. He established the fact that he has no credibility at all. This is part of the problem that we see here. Anyhow, back to the timeline. So we got the October bottom the moment the Fed capitulated and started to pivot. And then by December, we saw tax selling. Now, if you've been losing a lot of money in the stock market, you have to book your losses to reduce your taxes. So we saw a little bit of that happening in December. And then came the new year. 2023. And we saw the garden variety tax short covering. Anytime you have a down year, the next year, the first few weeks, the first few months, we see short covering as the shorts now book their gains after they avoided paying taxes the year before. So far, so good, nothing to see here. And then a few weeks in, we get the headline, the Microsoft bought ChatGPT. And that begins the AI mania. So we see stocks rallying higher, making a higher high. And then comes what? We get a slew of economic data suggesting that retail sales rebounded significantly the moment the Fed sent the false signal by downgrading interest rate hikes from 75 to 50 to 25. And with that came rebounds in CPI readings. Most importantly, the stickiness of core CPI. So the market reverses and starts to plunge down, saying that maybe the Fed will do more now. Maybe we misread the Fed. Maybe the Fed got it wrong. And now they have to go back to 50 basis points again. But then comes the collapse of Silicon Valley Bank. The market plunges again. But the market then, because the entire scope of the market right now is an obsession with the Fed, what the Fed will do and not do. And again, this is due to the recency bias. The market has been dominated by the Fed for the last 10 years plus, but the market cannot grasp that the Fed is no longer in charge. Inflation is. But anyhow, the moment the market sees the collapse of SVB and we see the emergency lending facilities by the Fed, the market looks around and says, you know what, this is actually good for us because we were worried about the Fed going back to 50 basis points. Now with the collapse of SVB and the banking crisis, perhaps they're going to plug the hole and they're going to start to reduce rates dramatically from this point on. We see a pivot, and here comes the Fed pivot optimism. And this kind of thinking is eerily similar to what happened back in 2008 when Bear Stearns collapsed. JP Morgan plugged the hole, and then the talk was, oh, the Fed now will cut rates dramatically. So you got to be bullish the stock market. And indeed, the market rallied higher. Until, of course, the lag impacts from all of these hikes in 05 and 06, and of course, the collapse of the mortgage bubble. We hit the systemic risk event, which is the collapse of Lehman Brothers. We saw a global contagion, and the market crashed, and the economy dived into a recession, the biggest one since the Great Depression. And I feel that this is going to happen again this time around. But anyways, one step at a time. The market rebounds and consolidates in or around the April to May period. And then what? We get a report from NVDA. And NVIDIA raises the revenue guidance by a lot. Confirming what? Confirming the AI mania. You could be concerned about banks, what the Fed is going to do and not do, but this AI thing is tangible. It's going to increase top lines, bottom lines, and corporate earnings by a lot. So you got to be bullish the stock market regardless of what's going on in the macro environment, regardless of what the bond market says. And then what happens? We see the retail mom and pops capitulating and igniting the former rally, piling in, chasing NVIDIA, chasing the next NVIDIA. And by the way, around that time, what happened? The Fed paused interest rate hikes. Major mistake. The market put two and two together. Look, we got an AI validation from NVIDIA. Oh, we got the Fed actually pausing interest rates. What's not to like here? Mom and pops, what are you afraid of? If you keep waiting on the sidelines, you're going to miss out. We see the formal rally. June, July, the market explodes higher. Then what happens? We start to get tech earnings. And they're disappointing. They're not really that good. We're not seeing anything from AI. And then, of course, comes the big kahuna, Apple, trading at all-time highs. Meanwhile, the report was mediocre at best, if not even horrific, with revenues down, profits trending down, iPhone revenue trending down, China revenue trending down, everything is trending down. Even the racketeering revenue, the services revenue by Apple, that's trending down too. And Apple goes down big. And now we are at the episode of what? Bond yields are now surging higher. Not because the Fed is raising rates, but because we have reinflation, as you see in energy prices. On top of that, we have other dynamics, such as the deluge of bond issuance by the Treasury Department, such as the Fed dumping bonds, such as China dumping bonds, such as the risk of the BOJ dumping U.S. bonds, such as Saudi Arabia dumping bonds. It's happening all over the place, not just in the US. We see bond yields in the long end surging higher and higher and higher. Now the question becomes, what landmine are we about to step on? Because so far, everything been benign. Little cuts here and there, little damage here and there from big tech earnings, for example, the seasonality, from the July CPI confirming that we have the bottom, and higher we go from here, the rebound, the PPI, that's some damage here. And of course, Apple earnings, and now we have the big one. In 1 week, we're about to get NVIDIA's earnings and Jackson Hole. If these two become a landmine, combined with bond yields surging higher, folks, the stress on the system is too much, and something big is going to blow up. You got to remember that the collapse of SVB all happened when yields were below where they're trading at right now. If yields continue to go higher, we're getting really close to the systemic risk event. And of course, this is prompting calls from folks such as Jeremy Grantham, who've called every single bubble since the South Sea bubble. I mean, he's that old. And now he says that the prediction by the hot dog stand we call Goldman Sachs is wrong. Not only that, but the rosy forecast by the Fed is almost guaranteed to be wrong. And there are many reasons why the rosy forecast by the Fed will be, I would not say almost guaranteed, I would say guaranteed to be wrong. We can talk about the landmines, we can talk about the AI hype, the bubble, etc., etc. But at the end of the day, it comes down to the bond market. You see, since the so-called October bottom, equities outperformed bonds in terms of inflows. There was an exception, of course, in the month of March due to the collapse of SVB, when we saw the rush to safety and buying bonds in lieu of equities. But then came the events that we just talked about, and we saw inflows into equities rebounding, while inflows into bonds lagged again. Until, of course, the month of August. And so far, we see inflows into bonds beating inflows into equities. What is the message here? Do you remember Tina? Well, Tina's now dead. If bond yields are paying you 5% plus, risk-free, with all of what's going on in the economy, why bother take the risk when it comes to equities? And as you can see, the risk premium for equities is collapsing, meaning that this is the worst risk versus reward environment for equities since at least 20 years. But somehow stocks are trading at all-time highs with valuations that are reflecting expansion. Forget about a recession. We're talking about expansion here. The market is absolutely delusional. So yes, the bond market says, no, I'm not wrong. I was not wrong. The market was and is wrong right now, which means that the reckoning hasn't even begun. But the good news is the cost of hedging is way too low, given all of these risks. Even as the market goes down, even as the S&P 500 starts to go down, the implied volatility is still too low. The cost of hedging and buying these puts is really cheap. You wonder why Michael Burry bought all of these puts? And why is this happening? It's the hubris, the delusion by stock market investors who think just because we have two letters, AI, that's going to cancel everything. The recession doesn't matter, bond yields don't matter, nothing matters. We don't even need to hedge anymore. It's arrogance, really. But too bad for them, volatility is now starting to catch up. And my hunch is we will see an explosion in volatility coming really soon. We're not talking about, next year or a few months from now. We're talking a few weeks from now. And the reason is bond yields continue to go higher, and there is no stop inside here. We have a lot of tailwinds that will push yields higher and higher and higher. And as yields go higher and higher and higher, something big is going to blow up. You see, Bank of America is now warning that we're going to have a 5% world, not just in the US. Everywhere, we're going to have 5% minimum when it comes to interest rates. Well, what is that going to do when all of this debt has to be refinanced? Well, here it is. Again from Bank of A, which has, by the way, been pumping the stock market higher. Maybe they're ashamed that they've been bearish for a long time. Now they have to overdo it with the clownish predictions and headlines. You got Savita Subramanian capitulating, saying that she's the most bullish she's ever been. You got all of these strategists from BofA saying the recession is not going to happen, an expansion will happen, everything's going to be fine. But with the same mouth, they say that the $1 trillion of high-yield debt that piled up in the last 5 years is about to have a day of reckoning, quote-unquote. What are they talking about? Here it is. The bank estimated around $1 trillion of high-yield debt has been accumulated by companies over the last 5 years, which has largely been created by below investment-grade corporations. Are you listening or not? About 25% consist of below investment-grade firms issuing risky high-yield bonds, while 35% consisted of broadly syndicated loans taken out by below investment-grade companies, the bank said. The remaining 40% was classified as private debt. And that's another hidden bomb that we have no details on. But what we can see right now is troubling enough. Furthermore, around half of that debt faces some risk of potentially defaulting, which could spell trouble for markets. Oh, you think? Around $400 billion of debt, for instance, is trading at rates above 6%, a range the bank classifies as pre-distress, quote-unquote, since refinancing those debt assets could yield a coupon rate of 10% or higher. Another $150 billion of debt is considered to be, quote, deeply distressed, end quote, since refinancing is no longer an option. U.S. central banks have raised real interest rates in the economy by 525 basis points to tame runaway inflation, which has significantly raised the cost of borrowing. Meanwhile, corporate defaults are surging, with total defaults in 23 already surpassing last year's total, according to Moody's Investor Service. Up to $1 trillion of corporate debt could be at risk of default if the U.S. rips into a full-blown recession. Actually, it's the chicken or the egg, right? The blow-up of this corporate debt will cause the recession as rates continue to go higher. But listen to this. Although BofA strategists no longer see a recession as likely this year. What are they smoking over there, BofA? You know, I got the CEO, Monahan, who's the biggest bullshitter on Wall Street right now. And I would say there was actually a real risk, a real scenario where we could see BofA blowing up entirely. So that CEO better wake up right now instead of just spreading propaganda and bullshit all over the place. Oh, the consumer is strong. Did you talk to the consumer? Of course not. They live in their elite bubble and somehow they have insights about what the consumer think and what the consumer is facing just by looking at some numbers. Meanwhile, they have absolutely no clue what they're talking about. They have absolutely no clue what's going on in the real economy. And of course, since we talked about the cost of hedging and how cheap it is, perhaps an important market event that took place today is the revelation that we now know Michael Burry, aka the Big Short, has bought an enormous amount of put options on both the Qs, the Nasdaq, and the SPY, the S&P 500. And of course, that's going to rattle the market. When folks see massive move by the Big Short, who actually predicted and profited from the last crash, when he makes such a large move using put options, which means the time is limited. In other words, Michael Burry is saying it's going to happen really soon. All of a sudden, the market listens. The exception, of course, the pumpers. For example, you got Kevin O'Leary, who now says that Michael Burry's bet against the S&P 500 is going to be painful, even if he's right eventually. That's the same Kevin O'Leary who told you to buy Zoom at the top, right? Anyhow, here's another one. He says Michael Burry is a one-trick pony, and the Big Short investors' massive bet against the stock market is a sure loser. Well, who's this genius? Here it is. He's going to be wrong like Mike Wilson was wrong. Mike Wilson was not wrong. The market was wrong. And this is coming from Mark Chicken, the CEO of Chicken Analytics. He dismissed the idea that Burry's portfolio update spooked retail traders into selling stocks this week. I promise you that nobody on Reddit follows Michael Burry. I promise you that nobody on Reddit even knows who you are. He also adds that there is always a Michael Burry out there. Whether it's some Bond guy, whether it is Stan Druckenmiller at some point in time, or Paul Tudor Jones, Chicken said. They're a lot smarter, by the way, than Michael Burry, with a lot more track record. He's a one-trick pony as far as I'm concerned, the stock analytics guru added. In contrast to Burry, whose latest wagers follow his repeated warnings of historic asset bubbles, price bubbles, and epic crashes, Chicken said that the S&P 500 is in a bull market and predicted it would not fall even 10% from its late July high. Now, this guy's not even worth a piece of dog shit that is stuck in the bottom of Michael Burry's shoes. Name one accomplishment by Mark Chicken. Crickets, nothing. Name one accomplishment by Michael Burry. We all know what it is. If Mark Chicken dies tomorrow, will anybody even notice? Even his dog would say, oh my God, what a relief. Now I'm going to go to bed or home. But if Michael Burry dies tomorrow, Twitter will be on fire. Or excuse me, X will be on fire. Enough said. Now let's talk some macro because it all ties in. It all ties into what? The icy hot phenomenon. You see, if all of the economy was responding to interest rate hikes and we're in the icy right now, then we would have said, okay, mission accomplished. By now, the unemployment rate risen a little higher. Capital expenditure by companies got reduced and the inflation rate is going down. We have what we call a soft landing, which is, by the way, keyword landing. There has to be a landing somehow, and in a garden variety recession, the Fed raises rates by a little bit, the consumer notices, they start to slow down spending. In response, corporate earnings start to go down, and they respond by laying off some employees, and the economy dips into a recession, a mild recession. That's what we call a soft landing. What the market is pricing in right now is not soft landing. What the market is pricing in right now is expansion, and that's really important to distinguish. Now, the challenge with the icy hot phenomenon, just like we saw, by the way, back in 07, 09. Even though today it's more, let's say, a bigger phenomenon than it was back in the GFC episode, but we have the icy hot phenomenon. And to take inflation out of the economy, you need all of these categories to go down to the icy. If some of them are stuck in the hot category, then they're going to require higher interest rates to crack them down. And higher interest rates, they're not really surgical as a tool. They're indiscriminate. So the pressure is added equally to all of these sectors. But certain sectors require more pressure than others. So raising rates to take the hot into the icy will take the icy into implosion. And then we get into the systemic risk event. Likewise, if the Fed, as cowardly as they are, they back off or they pause or they declare victory prematurely, what's going to happen? Categories in the icy will start to move back in the hot. And we're already seeing that happening because of the stupid pause. You see wages moving higher. And we have these delusional zombies who say, oh, this is the Goldilocks scenario, where wages are moving higher, but inflation is going down. The Fed has to pause and end the quantitative tightening campaign. Mission accomplished. Not only we have a soft landing, we have the best possible scenario of inflation going down, but wages going higher, and nothing is happening to the economy. Will somebody pretty please tell them to wake the up? Because when wages go higher, it means that the underlying conditions of inflation are still here, and they're thriving, which means that inflation will make a comeback. And now we have multiple episodes of strikes and wage hikes from UPS, from FedEx, from the airlines, and now we have auto workers. Massive strike is about to hit GM and Ford and many other manufacturers. 150,000 employees. What do they want? They want better benefits, better wages. That's wage inflation, which will feed into the economy and create more and more inflation. And perhaps what shook the market this week is the Fed's own admission that they see upside risk for inflation, possibly leading to more rate hikes. So all of a sudden, the assumption by the market that the Fed is near a pivot and the job is done and inflation is dead, even the Fed is saying, no, it's not done. And we know that. Now, when we look at the IC moving back into the hot, look no further than the Philadelphia Fed Manufacturing Index. And of course, again, the delusional clowns would say, oh, but categories moving from the IC to the hot means that we're going to see economic expansion. Soft landing, mission accomplished. What's not to like here? Well, here's what not to like. Sure, the headline reading for the Philly Manufacturing Index actually went positive, from negative to positive, but it also came with what? Prices paid exploding higher. Prices received more positive than the headline reading, but they see the number of employees going down. In other words, what the Philly Fed Manufacturing Index was actually pointing at is stagflation. Sure, we see the pace of economic activity moving a little higher in the headline reading, but that comes with higher inflation and less employees. Liz Ann Saunders from Schwab says inflation pressures coming back, ? Prices paid component within the Philly Fed Manufacturing Index jumped in August to the highest since June of 22, was among the larger increases on record. So again, inflation is going to come back. It's going to come back aggressively while the pace of economic activities deteriorates, while the consumer continues to weaken. The Fed will have to raise rates, and in this environment, something is going to break. And we will have a global crisis, not just a domestic one. But of course, what keeps the hope alive that this is going to be benign and we're going to live happily ever after when it's done is the labor market. And we continue to get more good news about the labor market. Jobless claims went down this week. But understand this, the labor market is usually the last to crack, because employers are not going to just fire folks at a time in anticipation of a recession. They have to actually see it to start getting rid of employees. So a lot of things will have to happen first before we see the unemployment rate moving higher. And a combination of persistent inflation, as we've seen with multiple corporate earnings, the input cost is not going down, it's actually going higher. But at the same time, we see consumers weakening. In other words, for corporations, the growth rate of the cost of sales and expenses is exceeding the growth rate in revenues. It is just a matter of time before they put two and two together and say, wait a minute here. The only remedy to this is to get rid of more employees. And then the labor market cracks. But rest assured, Goldman Sachs says don't worry about stocks with the Fed closing in on its dream no recession scenario. Now, so far we talked about the hotter side of the economy. Understand that we still have the icy, and not a lot of them are moving back into the hot. A lot of them are getting worse. When we talk about commercial real estate, we talk about zombie companies, when we talk about the debt. For example, U.S. leading economic indicators went down again this month. And this is the 16th consecutive reading of downward leading economic indicators. The headline reads, Americans will run out of pandemic savings next month, the Fed warns. Now, we were anticipating that's going to happen in October, but with inflation resurgence, the consumer will run out of savings by September. Poof, gone. And on top of that, they have to pay back their student loans. And oh, by the way, bond yields continue to go higher and higher and higher. The clams are now squeezing in, folks. The bond market rising higher, that's going to add a lot of stress on debt. The consumer weakening, that's going to add a lot of stress on companies. And the result will be either the stress on debt is going to show up first, and we see something big blowing up. Or the other scenario is that the stress on the consumer will show up first, and we see layoffs by companies, a massive wave of layoffs, and then bond yields go down, and we avert the systemic risk scenario. So when Goldman Sachs says, oh no, recession, everything's good, what the hell are you people smoking here? Goldman Sachs is collapsing, by the way. The CEO is busy DJing, the analysts are all over the place. It's not the same company you used to be. And I would say to Goldman, no, you actually got two outcomes right now. None of them is good, but one is better than the other. The two outcomes, once again, either the pressure from the bond market and debt is going to show up before the stress by the weakness in the consumer starts to show up. And if that is the case, something big is going to blow up, and we head into a recession either way. The unemployment rate explodes higher, and here we go, we have 2008 all over again. And there is no guarantee, by the way, that commodities inflation will go down crashing in that scenario, which means that the Fed will not be able to rescue, just like they did back in 2009. But of course, if the consumer blows up first, then corporate earnings will go down, unemployment will rise higher, and we will dip into a recession. And I would say that that's a little better for the economy because you're going to get the recession, but you're not going to get something big blowing up, a systemic risk event. But in either case, the outcome is a recession. And of course, when we talk about the clams squeezing in, it's not just from the debt side or from the consumer side, it's also globally. What about the contagion risk? If something blows up in China, in England, in Germany. When you look at China, for example, we know that Evergrande already filed for bankruptcy, and we know that our economy is really dependent on China. And if China goes down, the assumption should be our economy will go down. Our largest companies have huge exposure to China. If China goes down, our largest companies will go down. And we're not even talking about, the systemic risk event from bond yields moving higher or the consumer weakness here in the U.S. The weakness in China alone should permit a recession. But Goldman Sachs and the delusional pumpers, they say, what recession? What are we talking about here? Now, folks, let's segue and talk about the market specifics because we have an important week coming. So let's review the morning brief from Friday and see where we stand. Here it is. Good morning. I'm looking for a rebound, and this is why. The SQQs, if you look at the daily chart, it's outside of the upper Bollinger Bands, and the RSI will become overbought after the pre-market gap up. And all of this, by the way, is pre-market. The morning brief comes pre-market. Anyways, so I do see a gap and crap in the SQs, which means a rebound in the Qs, the actual NASDAQ. However, if you look at the weekly chart of the SQs, it suggests more gains to come and that the bullish momentum is in the inverse index is just beginning. In other words, we're looking for a transitory rebound, then a resumption of the selling later on. This is the chart that I gave you for the SQs, the daily chart. We pointed out that we could get really oversold in the RSI. It is already outside of the Bollinger Bands. We could see what it looks like, a gap and crap candle. Here's the update. Not quite a gap and crap because it closed positive, but it was a red candle. And the assumption here is we could see more downside coming for the SQs and more upside coming for the Qs, the actual NASDAQ, until, of course, things get back into balance, and that could happen in a day or two. On the other hand, when you look at the weekly chart for the SQs, what do we see here? The volume is moving higher on the buying side, week after week. This is a weekly chart. You look at the RSI. It is firming higher. Positive divergence. You look at the MACD. We must have a reversion to the mean in the MACD all the way to the zero line, which means that we have a long way to go before this is neutralized. In other words, the SQs will pop higher again. And what's going on in the stock market is a transitory rebound. Back to the morning brief, the Dixie. Looking at the 30 minutes chart, an impressive overnight rebound that will probably exhaust the dollar at some point today. If we see a reversal in the dollar, then this solidifies the potential for a rebound. The level to watch here is 103.570. If lost, get ready to trade some dips. And this is the chart that I gave you, 30 minutes chart for the Dixie pre-market. Look at this, potential reversal. If it goes below 103.570, you got a reversal. And here's the update. We went down. Not only that, we also lost 103.458. And that was a confirmation right here to buy or trade some dips. Then we'll look at the IWM, which is probably was the number one target for buying the dip. I will probably buy the dip here as we see the chart reaching its 100 MA during the pre-market session. Here's the chart that I gave you. We anticipated a rebound from the 100 MA. Here's the update. We went a little below, but we got a rebound. Maybe it has a little more to go, but it is a transitory rebound. That's all there is. Then we go back to the morning brief. The 10-year yield, 4.274%, is the number to watch. The hourly chart shows it is struggling to break above. If this ends in a rejection, then we will confirm a rebound day in equities. If I see my signals triggered, I will be buying the August 25th calls on IWM, Apple, and Tesla with a 2 to 3% rebound maximum. Here's the chart of the 10-year that I gave you in the morning. Here it is, an hourly chart. And the resistance here, 4.274. And here's the update, never made it above. And that was yet another confirmation that we have a rebound day in equities. Now, I gave you an update by the end of the day before the closing hour that I'm closing my IWM and Apple calls. Satisfied with the gains? Got the rebound? Thank you so much. But I'm going to leave TSLA calls to ride for next week in case the rebound continues. And the reason is Tesla is the one that did not work out. So if we have upside coming this week, at least Monday, Tuesday, then we reverse on Tuesday, for example, I'm looking at Tesla's chart and I see it really oversold. We gotta at least get a rebound out of that. And lastly, before we move on, how about NVDA? Let's talk about it because we have an important event this week, NVIDIA's earnings. It's all about the revenue guidance, but what is it really about? When we look at the wall of hope, we know that China is demolished right now. We know that the hopes for a Fed pivot is getting weaker and weaker as energy commodities rebound and as bond yields continue to go higher. And the only hope that we have intact in the stock market right now, although damaged, I would argue, is the AI fantasy. And it's all about NVIDIA. NVIDIA is the one that began the mania. It was actually Microsoft buying ChatGPT, but it was all about NVIDIA after that. So NVIDIA has the key to ending this AI mania altogether. And we know that analysts are getting out of their minds right now. They're all playing catch up. The NVIDIA rally caught them by surprise, and they're all being clownish right now, raising guidance, raising targets, upgrading NVIDIA. It is the best buying opportunity in history, according to the analysts. Maybe right at the top. You read these kind of headlines, maybe close to the top. You got another clown who now raised the target for NVIDIA to 800 from 600. You know what that means? NVIDIA perhaps will be bigger than Amazon. Are you insane? And the answer is absolutely, they are insane. Nothing is rational here, folks. If you are rational, you're among the few. But let's talk about NVIDIA here because there is a lot of chatter. There are a lot of folks who say, oh, it's going to crash and we have to start betting on it beforehand. And I would say, let's take it one step at a time. When everybody anticipates something to happen, probably it's not going to happen that way. It might happen eventually, but it might happen in a different scenario. So we'll look at NVIDIA's hourly chart. What do we see here? We know that 435.74 is a sticky resistance for now, but the chart made a higher low and it's challenging this number again. Could it go above it Monday, Tuesday until the report comes out? Absolutely. If we zoom out and we use a daily chart this time around, we have a few numbers here. We talked about 435.74, but above that we have 446.59. The stock could trade all the way up to that number before the report comes out. On the downside, we have 420. That's an important number. Then we have 400. Then we have 375. I'm actually rounding all of these numbers just so you know. After that, we have the gap at around 305.38, and after that we have 230. And then we have another gap down all the way at 207.54. Now let's plug in the Bollinger Bands, the 20 MA and the 50 MA. What do we see here? NVIDIA is trading below all of these averages. It's actually facing the 50 MA's resistance right now. It was below the Bollinger Bands for a little bit, and it caught a rebound, but it never really made it above the 20 MA. So this is relative weakness. It doesn't say that the stock is going to crash. It doesn't say that NVIDIA is going to miss. It doesn't say anything at all. Just something to keep in mind. What's important is, let's say that we lost the 20 and 50 MAs for good. Let's look down at the 100 MA. It's in or around 400, so this becomes a really important number and a really tough number to crack below absent of a tragedy, meaning a post-market crash because earnings came out and they're really disappointing. Absent of that, I think the 100 MA and 400 is going to hold pretty good. If we clean it up a little bit, another way we can look at the chart is perhaps an expanding channel with lower highs and lower lows, which we have seen in Tesla before the stock broke down. All of these are good things to keep in mind, but they don't tell us anything at all. So we have to look at the weekly chart. What do we see here? The RSI was overbought. Now it's still kind of overbought, but that doesn't say anything either. We'll look at the MACD indicator. What we know for now is we have a confirmation of bearish momentum. As you can see, the red impression in the histogram that registered this week, that is a confirmation that we have what it appears to be the beginning of bearish momentum. And what we know is sooner than later, regardless of what happens with the report, the MACD indicator in the weekly chart will have to go back to the mean. Going back to the mean meaning revisiting the zero line, whether the reading stops there or goes below. That's called the reversion to the mean. We are a long way from that happening, which means if NVIDIA really wants to go back to the mean in the MACD indicator, it should be down at around 300. Now, could that happen because of the earnings report? Sure. And if that is the case, let's just take that as a hypothetical scenario. That would be a downside from this point on for about 30%. Just keep that number in mind. Now, a lot of you say, hey Maverick, how do I trade NVIDIA? Do I buy puts? Do I buy the inverse index, which is the NVDA? Do I buy something else? Do I buy calls? Do I sell calls? Do I sell puts? What do I do here? I'm not going to tell you what to do because there is no right answer. There is no easy answer. It depends on what you see, what you forecast, and what do you want to bet on? Well, let's be honest here, folks. The assumption in the market is NVIDIA is going to crash. If it's going to crash by 30% in my hypothetical scenario, how do you play it? If you buy the NVDS right now, and NVIDIA indeed crashes all the way back to 300 by about 30% or so after the report comes out, your NVDS gains will take you all the way by about 37%. On the other hand, if you buy NVIDIA puts, the 300 puts this time around with the expiration date of August 25th, because there is no point of going beyond that. If it doesn't crash this week, there's no point of buying September 15th, for example, or October puts. Because if the stock blasts higher, then those put options will be worthless either way. So the bet should be this Friday, either it happens or it doesn't. If you buy the 300 puts as an example, and the stock goes down by about 30%, your gains would be at around 800 to 900%. In summary, what are the advantages or disadvantages of buying NVIDIA puts versus NVDS shares? And by the way, you're not buying call options on NVDS. It's not really that liquid as we see in the SQs or TQs or any of these large inverse indices. Buying call options on NVDS is a fool's errand. Just let's get that out of the way. But anyhow, in the case NVIDIA rallies and you have the 300 puts as an example, they're going to become worthless. If you own NVDS shares, your losses will amount to 1.25 times the gains of the actual shares of NVIDIA. If NVIDIA pops by 10% after reporting, then it'll be down about 12.5% in your NVDS shares. Let's say NVIDIA reports and the reaction is flattish. Then your NVIDIA puts, because they're way out of the money, this is the only way you're going to do it because there's no point of playing anything here. The only play is it going to crash or not? I'm not really looking to play a 5% downside or even a 10% downside. So in case NVIDIA's reaction is flat, you're going to lose 100% of your put options. Meanwhile, your NVDS shares will be pretty much flattish. Now, if indeed NVIDIA crashes by 30%, then your NVIDIA puts will score 800+% worth of gains. On the other hand, your NVDS shares will be up about 37% or more. So again, when you say, hey Maverick, how do I bet against NVIDIA? Do I buy the puts? Do I buy NVDS? The answer is it's up to you. What is your risk tolerance? What do you see? If you see NVIDIA crashing by 30% plus after reporting, then you're better off buying these puts. If you have a lower risk tolerance, then maybe you should buy NVDS shares. And maybe you can complement that by buying some NVIDIA calls as a hedge. You can do whatever you want here, folks. Just understand that there are multiple strategies. There is no right answer. There is no wrong answer. And there is no easy answer either. Now, for me, I do have NVDS. I have a little bit of a position here. So I'm going to let that ride. I believe that NVIDIA is at a top and NVDS will appreciate from this point on. But I'm going to complement my bet by buying the NVIDIA puts. But I know what the risk is, and if NVIDIA pops after the bell and those puts go worthless and my NVDS shares go down, I'm going to be just fine. And of course, on Discord, we're going to put a trade, which we usually do in pre-earnings, and these trades are usually neutral. They give you exposure to both sides with a slight bias to one side versus the other. And if you looked at the pre-earnings plays that we've done on Discord, we pretty much aced the majority of the earnings season. Be it Apple, be it Amazon, be it Meta, be it AMD. We made all of these plays with exposure to both upside and downside, with very little capital spent. And in certain cases, we made over 500% worth of gains from these trades. So I'm going to share that on Discord, but there is no easy answer here, folks. Lastly, if NVIDIA misses right off the gate, the stock is going to crash. But let's say and keep an open mind that NVIDIA will meet the revenue guidance, if not even exceed it. Then that's already priced in. So what is the stock looking at? It's looking at the next guidance and the year-end guidance. And if they come out light, then the stock will also go down. Because sure, NVIDIA might have aced this revenue guidance, but for the next quarter, the number is light. For the end of the year, the number is light. In other words, maybe we have seen a front loading of that demand, and we've already hit a peak. And of course, another troublesome outcome could be if all of these were just orders, just the word of mouth that company so-and-so will buy, or Saudi Arabia is going to buy however many chips from NVIDIA, but nothing really tangible. They can cancel these orders anytime. And the reason is, if you look at TSM's earnings, for example, and even the guidance, TSM is the manufacturer of NVIDIA's chips. And they're not seeing anything at all. They're not seeing an increase of orders all of a sudden. So what if what we've gotten so far is just a word of mouth orders, oh, we're going to order so-and-so chips, but nothing really materialized? That could be a massive problem for NVIDIA. But the way I'm approaching it is, I'm going to assume not only they're going to beat the guidance, but exceed the revenue guidance. I'm just being conservative here. I think what they're going to miss on is what happens after that. Now, if NVIDIA misses the revenue guidance altogether right off the gate, then my conservative expectations have been exceeded, and there is nothing to be mad about. Anyhow, folks, we can talk about this and a lot more later on, but we have to move on and cover the stock market information for you. We begin with the closing of the indices last Friday, and here we go. The Dow Industrial Average closing positive by 25.83 points, or a gain of 0.07%. The Nasdaq in the red by 26.16 points, or a loss of 0.20%. The S&P in the red slightly by 0.65 points, or a decline of 0.01%. And all of these readings coming by the indices closing at the highs of the day. When we look at the sector's closure on Friday, number 1 capturing the gold medal, energy. Number 2 for the silver, defensives. Number 3 for the bronze, utilities. All defensive/recession plays. The laggards led by communication services, cyclicals, and materials. When we contrast this with the weekly performances, what do we see here? All in the red, shame on all of them, led by cyclicals, real estate, and materials. When we look at the breadth on Friday, believe it or not, it was positive. The NYSE 60% advancing versus 37% declining. The Nasdaq 52% advancing versus 45% declining. So all in all, we're neutral almost, slightly positive in the NYSE, which means we can go either way on Monday. And we have no economic news coming out on Monday. All eyes will be in the dollar and yields, and we could see a continuation of the rebound. Maybe it gets us all the way back to the 60s, 70s in the Nasdaq, and then we come down again. We look at commodities on Friday. What do we see here? The dollar was down by a bit, and that was good enough for metals to rebound, for energy commodities to rebound, with the exception of natural gas. It was enough for grain commodities to pop higher. Finally, we have a sizable rebound in wheat futures, up about a little over 4% for the day. But to me, of course, the most concerning reaction is from heating oil futures, now comfortably above 3, and it gained about a little over 2.25% on Friday alone. Now, heating oil, that's diesel, which means that the cost of transportation of goods around the country will go higher. That's inflationary, and that's about to show up in the next reading in the CPI. So we have a lot of problems here, folks, even though when we look at the week all in all, commodities futures were down, but they're coming down from elevated levels after big rallies in the month of July. And of course, all eyes on OJ futures. They continue to go higher impulsively. I don't know if OJ is saying AI too. I don't know if orange juice is an AI play, but it keeps going higher and higher and higher. And you might have noticed that if you're buying orange juice in the store, it's going to cost you a lot. But in reality, the story of orange juice futures, the damage we see in crops in Brazil and in Florida, it tells you that it's more than just a monetary policy story. We have significant droughts, climate change issues, supply issues when it comes to energy commodities, with all of these cuts from Saudi Arabia, for example, the drought in the war in Ukraine and how that impacts wheat futures, the damage in crops in orange juice, in cocoa, the wildfires and the reduction of supply in lumber, the diseases in sugar crops, elevating prices higher, the shortage of meat, and we see meat futures exploding higher. All of these issues are not going to just go away and disappear, which tells us, folks, that we might see a stagflation environment for a very long time. The economy sours, we have a recession, but commodities inflation remains elevated for reasons beyond the monetary policy. Keep that in mind. On to the big casino, the options market. What do we see here? What we see is more buying of puts, be it on Tesla, be it in NVDA, be it in Apple, but we see some reversals. For example, not so long ago, we talked about puts outweighing calls in Microsoft. On Friday, we saw calls outweighing puts by a lot. So we could see the beginning of puts stopping off for now. And we see a lot of suckers getting sucked in here, believing that this is the bottom. They start to buy some calls, and then they get slaughtered again. And of course, the Johnny-come-latelys who bought the puts on Friday, they might get slaughtered in the meantime. We look at the 5 days average put-to-call ratio. Calls were extremely outweighing puts in the month of July. And then we bottom. We called that in this program. The moment we bottom, we start seeing buying of puts. That's the moment when the market is going to top and starts to go down. And now we're back at the neutral line, 1-to-1, 50-50. Can we dip down a little bit and we see more buying of calls? We see the market rebounding, and then we see more buying of puts because of Jackson Hole, because of NVIDIA, because of whatever. We explode higher, where puts way outweigh calls. And then we know that we're in the climax. We have perhaps a more sustainable, a more tradable rebound than the one we got on Friday. Keep that in mind. Now, when we talk about the zero DTE phenomenon, on Friday, believe it or not, we saw a reversal in trend. We've seen puts outweighing calls when it comes to the top traded zero DTEs plays. And that kind of amplified the downside in markets, specifically in the last hour, middle of the day, we see sharp pullbacks. On Friday, we saw the opposite. The market actually rallied into the close, and the reason is the top unusual activities, the top zero DTEs were all calls in the queues. Or look at the SPY, same thing. The top trades were all calls. So the zero DTEs, they act as the amplifier of the action, but it's a change in sentiment. They used to buy puts throughout the week. Just the top trades, zero DTEs were all puts. Friday, there were calls, and therefore I say that the rebound that we got on Friday could sustain for a little longer, and then it's going to hit a wall. And perhaps this is what the unusual activities that we got on Friday are telling us. I'm not going to read all of these trades for you, but I want to spot a theme here. And the theme is we have a put options trade in the queues, betting for a 5% plus downside by the end of the month. We have a weekly call for the SQs, the inverse index for the Qs, to pop by more than 8% by the end of the week. We have put options on the IWM, also with short expiration dates, betting that the IWM will go down by more than 5%. What is the message here? The market, at least the bettors here, are saying that whatever we got on Friday, it's a transitory rebound. It could go a little higher, but by this week, Tuesday, Wednesday max, we're going to reverse and go down again. It's going to be a sharp pullback. Moving on to the heat map, what do we see here on Friday's heat map? The answer is it's all over the place. Obviously, the consistent theme is the weakness from China. We see Chinese equities such as Alibaba, Pinduoduo, JD, even the auto manufacturers Li Auto, Neo, and names with exposure to China such as EL, Estée Lauder, or Nike all down for the session. And I think that ties in with the weakness that we got in copper on Friday. Even though the dollar was down, you'd think that copper should go higher. And by the way, copper futures were higher, but copper stocks were down. Maybe this is due to China. The bad news that we continue to get from China. Baidu was down. Deere is yet another name that is tied to China, which is the largest buyer of U.S. grain products. Well, if that demand is weakening, you're going to see Deere down. Of course, Deere reported and maybe was not a good report. So it could tie in with the China theme. It could be an idiosyncratic event due to earnings. But then again, you look at Tesla, that's down. That could be argued that it's related to China. We're going to look at Tesla's numbers by details, by the way. The sales in China not doing pretty good. But on Friday, energy did pretty good. Defensives did pretty good. Healthcare, few pullbacks here and there. You look at technology and chips, we have AMAT, the outperformer due to earnings. But besides that, the action was all over the place. It was negative in the morning. Then we caught some rebounds. Yet when we contrast this with the weekly heat map, it is telling. Here we have a bloodbath across the board with few exceptions. And these exceptions are the AI mania. NVIDIA was up about 6% for the week. Oracle, it ties in with NVIDIA and the AI mania. That was also up for the week. And then we look at the weight loss mania in pharmaceuticals. You got Eli Lilly, that was up again for the week. NVO up yet again. And of course, we got some bad news from the thing front, which is the virus. Now it appears that we have another variant. They call it the Taylor Swift variant. And you see Pfizer, you see Moderna moving higher again. But besides that, besides some earnings plays such as TGX, for example, it was a bloodbath across the board. Energy down, metals down, industrials down, cyclicals down, everything's down. Big caps are down. Meta is now playing catch up, down about 6% for the week. Tesla was down over 11% for the week. The Chinese names got annihilated. And of course, when we look at the banks, keep a close eye on BofA, one of the largest banks in the nation, down about 7% in a single week. Something big is happening there. And then you got Schwab, that's another one, down about 7% for the week. When we talk about bond yields moving higher and the systemic risk, I would say look no further than banks and even the big ones now. We contrast this with the weekly heat map for the ETFs. What do we see here? Again, every single ETF is in the red, bloodbath across the board. Massive losses for anything that is dollar sensitive because the dollar went higher this week. So we see the FXI Chinese equities down big. We see the GDX gold down big. And of course, yields went higher. And that's not going to be good for what? For the KRE, that was down big, over 6%. Regional banks, not good for the home builders, XHB, ITB, all down big for the week. Not really sensitive to the shorter end of the yield curve, but if the 30-year starts to move higher, you see a lot of pain in home builders, Lennar, DR Horton, XHB, ITB, they all go down. Whether we're talking about large caps, small caps, mid caps, all down, even value was down for the week. And the only exception is the XME, which was slightly positive for the week. And the reason is we have the M&A mania in steel. We got the news that Cleveland-Cliffs wanted to buy U.S. Steel, and now we have another company that wants to do the same. So we have a little bit of a bid war here. And they managed to push the XME to the positive line, but I don't think that's going to last. I think steel stocks will go down so long as China continue to be weak. Let's do some charts and then wrap it up. When we begin with the SPY, the S&P 500, an hourly chart, what do we see here? What we see is we got an oversold rebound exactly from where we anticipated, which is the support zone at around 433.79 and 434.64. And now what? We closed pretty much at the gap at the highs of the day, which means if this wants to go higher, it can, and it will, but it's going to face a steep hill decline. We have 438 as resistance number one, then we have 439.45, but the next important line becomes 443, and I'd be really surprised if the rebound gets us all the way to 443. Look at the daily chart for the E-mini futures. What do we see here? Again, we got a rebound, and we closed exactly pretty much at around the support line of 4,384.5. A little below, but it's not a big deal here. It looks as perhaps a bottoming candle here, but I would say be careful. We don't have a confirmation until this chart closes above 4,472 on daily basis. Other than that, whatever rebounds we get will be transitory, and down we go again. And of course, the ultimate target here is for this pullback is 4,300. If we go down to 4,300, we're going to erase the entirety of the June and July rallies. And then we go back to what do we do for now? We have erased the post-NVDA mania. We've erased the pause mania by the Fed. And the retail investor, of course, got slaughtered. Now what? Now what do we do from here? And I think that's a conversation worth having. And if the conclusion is, oh my God, something's going to happen as in systemic risk or bond yields continue to go higher, then the market will have no other choice but to continue to go down. But for now, we got a rebound. Maybe there's a little more to it, and then we'll see what happens. If the rebound fails and we crack below 4,384.5 again, the pain will resume and the target will become 4,300. Now, to be specific with you, let's say the chart rebounds. This is the E-mini futures, but this time around we're using an hourly chart. Where could it stop besides 4,472? The answer is, how about 4,427.5? Keep that number in mind. We could see a rebound takes us all the way there and then face some resistance and pull back, crack below support, and here we go again. What about the SPX, the cash index? We're using a daily chart, and we're using the Bollinger Bands, the 20 MA, and the 100 MA this time around. As you can see, we got a rebound from in or around my number, 4,337.85. The chart is extended way outside of the Bollinger Bands. It deserves a pullback, it deserves consolidation for a little while, and that could take us above 4,385. But here's the problem. The fact that we caught a rebound before 4,300 and before the 100 MA tells me that this is going to be transitory. Then down we go in a retest to the 4,300 level and the 100 MA. And that should be a stronger ground for a more sustainable rebound. But for now, we can go higher by about, let's say, 1% or so, and then see what happens. We look at the SPX once again from a weekly chart perspective this time around. We got a rebound, but not off the 20 MA. In other words, you look at the RSI, negative divergence, you look at the MACD indicator, still in bullish momentum. It's about to cross, it's about to produce bearish momentum. What does that mean? Whatever rebound we get will be transitory, and down we go again, or we're going to cut through the 20 weekly moving average. In other words, the weekly chart says if there is a reversion to the mean in the MACD indicator, 4,300 will not be enough because cracking below the 20 moving average in the weekly chart will mean 4,300 will be lost. But again, one step at a time here, folks. We look at the monthly chart for the SPX, the cash index. What do we see here? We know that we have a trend line that goes all the way back to 2009. At some point, we're going to have to go down there. And right now, you look at the RSI, that's curling down. You look at the MACD indicator, it appears that we got some positive momentum right now, but it's losing momentum. It's about to go down and produce bearish momentum once again. In other words, we could see the ABC pattern all the way down to the trend line. Now, the question becomes, is it going to happen in one shot, in a crash, let's say, because NVDA missed, or because Jackson Hole, or because of whatever, fill in the blank reason, or is it going to be gradual? And the answer to that is really important. Why is it important? Because if you happen to be Dr. Michael Burry, for example, and you have all of these puts that you bought, you want to see the one-shot scenario. If it goes gradual, your puts are going to decay and lose a lot of value. We'll look at the Qs, the NASDAQ, and hourly chart. What do we have here? We got an oversold rebound. And it happened slightly below my number, which was 357, but the chart did close above this number. In other words, if it wants to go higher, it can go higher, and we have 360.42, we have 364.11. We can go all the way back to 365. But the problem is, if you look at the chart, the bears would argue, isn't this a bear flag consolidation pattern? It's not going to go at 365 because it's going to crack right now. The bulls will counter and say, hold your horses, we are really oversold here. Look at the MACD indicator. We need to see at least a little bit of positive momentum for a few hours at least, and then we can go down again. In other words, the beauty is, if you bought the rebound, you did not get out on Friday, and you're feeling kind of stressed out, the market can go down, you're going to have the opportunity to exit. If you feel that you missed out a little bit on the downside and you want to open new puts, for example, you're going to have an opportunity to do that too. That's the beauty of what's going on right here. But then we have to look at the daily chart for the continuous contract for the NASDAQ. What do we see here? We got a rebound from in or around the support of 14,675. It's an important number, and it held right now. But a more important number is 14,445, or we can round that up to 14,450. At some point, we're going to go there. We have to close the gap, folks. This is a continuous contract. So what does that mean? Whatever rebound we get from here, it will be transitory. It can get us all the way back to 15,000. Even if it does, the chart will not become bullish again until we have a daily closing above 15,500, which is a long and a steep hill to climb. And the way down is easier than the way up. That's all I'm going to say. Now we'll look at the NDX, the daily chart. We use the Bollinger Bands, the 20 and 100 MAs. What do we see? The momentum is bearish, be it in the RSI or the MACD, but we're getting a little oversold here, or we're getting way outside of the lower Bollinger Bands. So we have to go up in a correction here. It can take us all the way back to 15,000 if it wants. But again, folks, it's not over yet. And the moment we fix the divergence outside of the Bollinger Bands and the oversold conditions in the hourly charts, I think we will go down again to the 100 MA. Not just in this chart, but in many others. We look at the weekly chart for the NDX using the Bollinger Bands and the 20 MA. What do we see here? The RSI is in negative divergence now. The MACD indicator has given us confirmation that we have bearish momentum in play. In other words, will the 20 weeks moving average hold? If you look at the MACD indicator and the reversal to the mean, the answer is probably not, which should be terrifying to anybody who wants to buy the dip right now. That we could crack below the 20 MA after a rebound, and then we'll be down to 13,000. That is entirely possible. And the reason is, if we plug in the 100 weekly moving average, if we lose the 20, then we have a downside of about 8 to 9% from this point on. Keep that in mind. And top to bottom, that would be a decline of about 15.5%. So it is kind of a garden variety correction after a massive rally, but it is at the high end of the garden variety range. Then we look at the NDX, the monthly chart. What do we see here? The answer is we have a trend line that goes all the way back since 2016. At some point, we have to go down there. And if you look at the RSI, it is weakening. It is in negative divergence. If you look at the MACD indicator, it's also moving back down. So we could see the inverse ABC pattern in one shot or gradually. It takes us all the way back to the trend line, forming the maverick top. And then we have the IWM, the Russell 2000, an hourly chart. What do we see here? We got the oversold bounce from in or around 182, forming what it appears to be a bull flag pattern just underneath 185. Can it continue? Sure it can. If it wants to, it can go higher. Here's the problem. You look at the daily chart for the IWM. We got a rebound from the 100 MA. It was oversold to begin with, but if you're betting that this is the bottom and the IWM will rally all the way back to the 20 MA, you're sadly mistaken because it's a steep hill to climb. We have a lot of breakdown candles here. In other words, we need a fundamental catalyst to get us all the way back to the 20 MA, not just in this chart, but many others. And the only fundamental catalyst that we have is NVDA acing the report and guiding another report higher, and Jackson Hole coming out benign. Other than that, whatever transitory rebound we got right now will indeed be transitory. And down we go again. My target for the rebound in the IWM is 186.74. This will be an important test for the rebound, and then let's see what happens. The Dixie, a daily chart, what do we see here? It caught resistance at around 103.6. It is a rejection for now, no confirmation yet, but we could see it pulling back all the way to 102.840 or all the way down to 101.915. And I would use this chart as my guide of how far the rebound in equities will go. If the dollar goes down and it rebounds from, let's say, 102.840, it's going to be a short-lived rebound in the Qs. In the IWM, the SPY, and down we go again. If the dollar goes down and rebounds from 101.915 instead, then the rebound in equities will be larger. But again, if you have a rebound in the dollar either way, from either target, we're going to see a formation of an inverse head and shoulder, which means the dollar wants to go higher. It's just taking a break here, and the break is allowing equities to rebound from oversold conditions. That's all there is. And then down we go again in equities and higher we go in the dollar. You look at the old man gold daily chart, what do we see here? It is becoming oversold. It is holding on to 1893. Can we say that this is a wedge-ish pattern? We'll see a rebound perhaps all the way to 1928, for example. Really possible. If the dollar pulls back, gold is going to pop. But here's the problem, folks. It could be a rebound, then crap again, as the dollar rebounds. If you look at the weekly chart for gold, what do we see here? We have a trend line that has been broken. We have a confirmation of the negative momentum. And we have perhaps a confirmation of a topping head and shoulder formation. In other words, gold says, forget about any rebound in equities. They're not going to last, and the dollar is going higher again. And this is, by the way, confirmed by the GDX, which is gold miners. We look at the weekly chart for the GDX. Here it is again. We have a topping head and shoulder formation, at least for now. We look at silver, the SLV daily chart. What do we have here? It is getting oversold. We have a little bit of a rebound here. Can we add to this rebound? The answer is absolutely yes. But you look at the weekly chart, once again, we have the dreaded head and shoulder pattern. Although in the SLV's case, it did not really break any support line, as we see in gold. We look at UK oil, Brent, what do we see here? We got a rebound. We closed above 82.5. That's the good news. The question now becomes, if the dollar is going to pull back, wouldn't that allow more upside for crude oil because it has been rallying as the dollar was rebounding higher? So if the dollar backs off, shouldn't that be an added boost for crude oil to move higher? The answer is yes. But bear in mind, the correlation between crude oil and the dollar hasn't been really spot on as of late. On the other hand, the correlation between crude and the 10-year yield, for example, has been absolutely spot on. In other words, crude now cares more about the 10-year yield, not so much about the dollar. So we have to look at bond yields and see what's going on here. Look at the 2-year, what do we see? Consolidating in a bull flag pattern above 4.87, which means we should see the 2-year moving higher. But this week and the week before, it has been all about yield curve steepening. Why? Because the 2-year has been flattish, the 10 has been moving higher, and now it's challenging the highs once again. Can it pull back from this point on? The answer is sure, but is it going to be a top? There's no confirmation for that yet. Can we see a pullback and then it gathers the energy required and it moves higher to make higher highs? And that would be shocking to the stock market. But in the meantime, as it pulls back, wouldn't that allow equities to rebound a little more? Keep that in mind. If it cracks above the previous high right off the gate, then the rebound in equities is over. We look at the 30-year. What do we see here in the daily chart? At the highs again. Maybe it's going to fail this time around, go down a little bit, gather some energy, and then pop higher. Look, if the 10 or the 30 wanted to go down and form a double top, why bother? Why did they rally all the way here? The answer is they want to go higher, and they will go higher. The question now becomes, is it going to happen right away, or is it going to happen after a pullback? If it is the latter, then it allows for the rebound in equities to last for a little longer. We look at the VIX daily chart. What do we see here? We have the cup and handle formation playing out, the higher low. We have a closing above 17.08. And that's a win for volatility, indicating that we have more pops to come. You look at the weekly chart, what do we see here? Positive divergence on the RSI, positive momentum building up in the MACD indicator. And every time we've seen such build up in the MACD indicator, in the form of positive momentum, we have seen big pops. The latest, of course, the SVB crash, the pop that came after that. So it could be on the cusp of a big pop and volatility here this week, be it because of NVDA, be it because of Jackson Hole. And the number that everybody's talking about is 22. We'll see how it's going to hold. And then we have Apple, an hourly chart. What do we see here? Oversold rebound, but it did not even bother recapturing any support line. Was it a good rebound to play? The answer is yes, and we did play it in this channel, but is it convincing that we have at least a tradable bottom here? The answer is absolutely not. All what we have is an oversold rebound. You look at the daily chart using the Bollinger Bands and the 100 MA this time around. We're below everything. The chart is below the 20 and the 100 MA. And these are significant breaks, ladies and gentlemen. It's not happening from a meme stock or a small cap stock. It's happening in the largest stock in the world. It's a leading indicator. It's a message that all of these charts will go down to the 100 MA, and that's not going to hold either. So what if we plug the 200 MA? Well, now we're talking. Now we're getting closer and closer to the conclusion that Apple will have to go down even more. The problem is it's still oversold at this point. So can we see the rebound continuing into Monday, Tuesday? Sure. But at some point, sooner than later, Apple is going down again. You look at the weekly chart, we have a closing below the 20 weekly moving average. We have a confirmation, the RSI, the MACD indicators, that we have bearish momentum now, which could take us all the way down to the 200 weekly moving average, which will be in or around 150. And I believe that 150 is a number that we have to go and revisit, if not crack below. You look at the monthly chart for Apple, what do we see here? Negative divergence in the RSI, negative momentum about to show up in the MACD indicator. We have a reversal candle so far for the month. If it closes that way, all roads are saying that Apple will go down. If Apple goes down, the market will go down with it. Look at Tesla, an hourly chart. What do we see here? Way oversold. We're waiting and waiting for a rebound here. We have 220. We have even all the way up to 234.86. It could happen, but it needs to happen sooner than later. Monday, Tuesday max. Otherwise, the oversold conditions will be fixed a little bit, and it opens the path for Tesla to go down even more. You look at the daily chart, what do we see here? Outside of the Bollinger Bands, becoming oversold, and it is below the moving average, so we're waiting for a rebound. After the rebound is done, and the chart is no longer oversold, we're going to go down again. Because you look at the weekly chart, what do we have here? We have a closing below the 20 weekly moving average. We have negative divergence in the RSI. We have a confirmation in the MACD that we have negative momentum building on. It's not done yet, and Tesla is a leading indicator that for the MACD to go down to the mean, we have to go below the 20 weeks moving averages. And it gets even more disturbing for Tesla. If you look at the monthly chart, look at this. The MACD indicator never got positive, and now it's curling down. The RSI indicator was in positive divergence, and now it's about to break that. And of course, we have the dreaded head and shoulder topping pattern. Of course, the Kelties will never really book profits. They will never really admit that this stock is going to crash because of the robo-taxis, because of Elon is going to do this and that, because of whatever. But my message to you is you gotta hedge. From my perspective, this stock is going down, and it's going to go down big. And we're talking sub 100 comfortably. Are you really prepared for that kind of pain? Why the arrogance? Why not hedge in case the trade goes against you? At least you're covered. Look at Amazon, AMZN daily chart. What do we see here? It lost the 20 MA. It lost the support of 136.45, but it's not really overbought or oversold, not even close. It is now rebounding from the 50 MA, but it has negative divergence in the RSI and the MACD indicators. So, can we see a rebound all the way to the 20 MA, even to 136.45? Sure, but for now the indicators say that if we break the 50 moving average, then the floodgates will open for Amazon, and it's going to catch up with Apple, Meta, Microsoft, and the rest of them. But for now, Amazon is the strong in the big caps, not the weak. Look at Google Alphabet. What do we see here? Using the Bollinger Bands, the 20 and 50 MAs, what do we see here? Relatively, it's stronger than Apple, stronger than Meta, stronger than Microsoft, and the reason is it is the laggard, along with Amazon. For now, we lost the 20 MA, we lost the 129 support line, so this is negative, not positive. The negative momentum in the RSI and the MACD indicators is accelerating. If we go down, we have the 50 MA to look forward to. If that fails, then we have 121.36 and 117. But again, this is the strong, this is not the weak. The weak is Apple, Microsoft, Tesla, and Meta. If you look at Google, a weekly chart, what do we see here? Could it join the ranks of the week? The answer is absolutely. Negative divergence on the RSI, and the MACD is about to lose positive momentum for the first time of the year. And we have the 20 moving average in the weekly chart to look forward to. You look at Meta, here it is, using my support lines, the Bollinger Bands, the 20 moving average, and the 50. And the chart's now below everything. The trend lines, support lines, Bollinger Bands, 20 moving average, 50 moving average. Is that negative or positive? The answer is it's negative, it's bearish, but we're due for a rebound. So we get the rebound, and then what? If we clean up the chart a little bit, we can go back to the 50 MA. That proves to be a tough nut to crack again. What happens? We have to go down to another moving average, in this case the 100 MA, which is a little below here. It could coincide, if we plug in my numbers again, with 268.32. We look at the weekly chart, what do we see here? The RSI is in negative divergence. The MACD indicator has given us a confirmation that we have bearish momentum. We're way above the mean. We need to go down a lot for this chart to revisit the mean, which means that the 20 weeks moving average perhaps is not going to hold. Are we going to go down? If we go down, how far can we go? The answer is we have many support lines here, 253.57. We have 224.20, but we'll take it one step at a time, folks. We'll look at Microsoft, the daily chart. What do we see here? Below important support lines such as 320, below the 20 moving average, and below the 50 moving average. Is that bearish or bullish? The answer is it is bearish. But we got a rebound from a gap closure at 313.85. Can that take us all the way to the 50 moving average? Sure. But at some point we have another failure and more downside coming. If we look at the weekly chart from Microsoft, we lost the 20 weekly moving average. And again, Apple, Microsoft, all of these are leading indicators that the indices and other stocks will do the same. They're all going to crack below the 20 weeks moving averages, which means where is the next stop? If we use the 100 MA on the weekly chart, maybe that's the next stop for Microsoft, after rebounds, of course. And from this point on, that means a downside of about 10% in one of the largest stocks in the market right now, one of the leaders of the AI mania. If we look at the monthly chart, what do we see here? Look at the RSI, negative divergence, and now moving back down again. So is the MACD. It appears that we have a top, and now we're getting the confirmation. We have to go down to the trend line as a minimum, which extends all the way back since 2018, forming, of course, the maverick top. And if we go down in one shot, that could be a downside from this point on of about 25%. Lastly, we look at Bitcoin. What do we see here in the daily chart? The answer is, how about a meltdown? I was bullish, I was optimistic, I was keeping an open mind. So long as we're above 29,200 and the dollar pulls back, there is a potential for Bitcoin to pop higher. But then came the news that Elon Musk, of course, with his pumps and dumps. Now we have SpaceX dumping Bitcoin. It flushes down. Now it's really oversold. Is it going to rebound this week? Maybe. I think it got crushed, overbeaten really, because if the dollar goes down, the easiest trade this week would be buying the dip in Bitcoin, at least in my opinion. Could it be catching a falling knife? Sure. And this is why it's going to be fast. If you see the dollar down, if you see the market rebounding, if you see Bitcoin recapturing 26,555, you can play a rebound, but you got to be really careful by booking your profits right away. And the reason is, we look at the weekly chart for Bitcoin. What do we see here? It was forming a series of higher highs and higher lows, aka a trend line. The trend line is now broken, which means we have more pain coming for Bitcoin. But on the daily chart, it's really oversold, due for a rebound. We get the rebound out of the way, and then down we go again. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? On Monday, nothing, so it's a good day for a continuation of the rebound. And then on Tuesday, we have existing home sales. Wednesday, the 23rd, we have the services and manufacturing PMIs, along with new home sales. Thursday, the 24th, we have Jackson Hole, the interviews, the initial interviews. Then we have initial jobless claims and durable goods. And of course, Friday, the 25th, perhaps the most important day, we have the speech by Chairman Powell at Jackson Hole, and we have the final reading of the University of Michigan Consumer Sentiment Index. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
What are you drinking? I don't know. What am I drinking?